CBDC and monetary policy among David Andolfatto from St. Louis Fed, Matthew Boussière from Banque de France, and Linda Schilling from Olin Business School.
Yeah, so thank you. Thanks for attending, and we have a last minute substitution. So Adrian Penalver is filling in for Matthew. He's the deputy director of Monetary and Financial Studies Directorate at the Banque de France. So the topic of this session is CBDC and monetary policy, and so we're going to try and discuss this issue. And of course, it's hard to talk about how beneficial CBDC might be for monetary policy in general terms, because it's going to of course differ across different countries, different situations, just as the motives for CBDC differ across different countries and different situations. So, for example, if we think about the situation in many emerging market economies, there I think the role for CBDC is often thought of more to facilitate payments or to improve financial inclusion. And when we think of emerging market economies, it's quite different, because they often don't have that much payment infrastructure that they're attempting to change or improve upon. In fact, Shea Suri, who's the deputy governor of the National Bank of Cambodia, once said in a conference, "We don't consider blockchain technology to be disruptive because there's nothing to disrupt." And so it's a very different situation. But when we think about emerging market, or when we think about developed economies, which I think primarily we'll be focusing on today, we have well-functioning payment systems. We have many years of monetary policy experience that has led to the types of monetary policies we do today, sometimes with more success, sometimes, I guess, with less success. So it becomes I think, a higher bar when thinking about what the benefits of CBDC can be. So anyway, without my going on any further, let's go ahead. Each of the panelists is going to make just a few remarks, and then we'll have a general discussion. So I think sitting next to me is David, so let's go ahead and start with David.
Yeah, I do have a slide deck. I don't know if they don't fire it up, it's okay. Anyways, I'd like to thank the conference organizers for inviting me here. Do we have the slide deck or not? Just let me know and I can... Oh, Andolfatto? Oh. Yeah, thanks. How do you like that title page? It's pretty... Yeah, thanks. CBDC and monetary policy. Just a quick outline of my remarks. I thought that since we're talking about CBDC, I'd spend a moment and just define it, kind of, at least the way I'm thinking about it. I'll talk a little bit about what I think the implications are for banks and also for shadow banks. And then I'll discuss the implications, what I think the main implications are for monetary policy, and just conclude briefly whether I think a CBDC is desirable or necessary, and if not necessary, if it might not be desirable in some cases. So what is a CBDC? You know, I guess it means different things to different people. But for me, you know, the first approximation, I'm just thinking they're just fully insured online checking accounts with your friendly neighborhood central bank, or potentially not the central bank, could be the Treasury. Maybe not many people know this, but in the United States, today all U.S. persons are permitted to have access to online Treasury accounts. Just go to www.treasurydirect.gov and you can open up your own interest-bearing treasuries. Now, it's not hooked up to a payment rail, but you could imagine hooking it up to a payment rail and paying for your Starbucks coffee using Treasury coins. And of course, we could also conceive of this product being offered through the post office. And in fact, the United States, like many countries, does have a history of postal banking in the United States for the better part of the last century. And it operated fairly well, kind of died out because of federal deposit insurance. But I'm basically thinking about checking accounts at your neighborhood central bank, and kind of the account-based ones, I guess. Yes, the post office, yeah.
So what you call the Landesbank in Germany, would that also be CBDC? Or
Yeah, why not? Why not just hook it up to, yeah, I think that's right. I don't think there's,
just state-run banks under CBDC?
yeah, well, not state-run, but I mean, they'd have to be issuing not state-owned, but they'd have to be issuing liabilities that are kind of the legal tender. And I don't think state banks necessarily, well, it was fully, I'm sorry, it was fully insured, so you're right. It's a narrow banking, correct, yeah. So I would count the Chicago school kind of narrow banks as falling in this category. And of course, I'm aware you can make subtle distinctions in Rod's money flower. You have the token-based ones and everything else. But to a first approximation, you know, and from the perspective of monetary policy, which is the subject of the panel, I just think about it as online checking accounts at the Fed. And many of the details concerning design, I think for the purpose of this discussion, we can ignore, primarily because I think a lot of these properties can be built into just private sector products as well, things like programmability, issues relating to privacy of data, ownership of data, et cetera. The two important dimensions I think that are important for CBDC are first the remuneration. This is different than private banks, private sector agencies that operate on a profit motive. The central bank is in a position to set the interest rate public policy concerns. It doesn't have to abide by a profit motive necessarily. So that's one big difference. And secondly, you know, the central bank is the issuer of the, you know, ultimate settlement object. There's no risk. These accounts would be fully insured almost by definition, and there's be no counterparty risk associated with these accounts. I think these are the two distinguishing characteristics. The comparative advantage, I would say, that a central bank digital currency has over any private sector alternative. At the end of the day, I think what matters is how attractive depositors view CBDC relative to competing products, and in particular bank deposits, but also the deposits of other money services businesses like PayPal, for example, and also potentially stablecoins. What are the implications for banks? Well, Rod gave a very nice paper and talked about this a lot. You know, but to me, I mean, I'm thinking, I talk to these regional banks in my district, you know, and I think they're worried about the Bank of America, you know, these big banks. And I think to a lot of banks, a central bank is just going to look like, you know, the Bank of America. I mean, it's not as bad maybe because the central bank won't necessarily be doing the credit business, but it certainly would be competing for deposit funding. And I don't think I'm going to say too much about this because I think Rod covered it, all of it basically in his model. I mean, at the end of the day, I think a lot of the concerns that have been expressed about disintermediation for banks at the retail sector, I think are really grossly overblown, especially for the United States. Whereas Rod mentioned, I think, I mean, profit margins, you know, the interest on reserves is likely to be greater than the CBDC rate, and as a result, CBDC is likely to squeeze profit margins, but not likely to disintermediate bank lending. And I think Jonathan has a paper with a similar result. Or Jonathan's paper actually, the CBDC might actually crowd in some, I think, right? Not the paper you presented, but I was referring to the earlier one. Yeah. Okay, so, right. In terms of, you know, shadow banks here, I think this is, a neglected part of the discussion. Most of the discussion seems to be at the retail level, fair enough. But I actually think that potentially a CBDC might have very, very dramatic implications, especially in the United States at the wholesale level. Especially, you know, depending on design characteristics, if there are no cap limits in particular, the safety of this object and the lack of counterparty risk, I think, could potentially be very attractive to corporate cash managers. You know, people managing $50 million, you know, they have to park it in a safe place for a few days. what do they do today? They don't put it in a bank typically. They go to, they invest in a treasury, you know, treasury securities. Treasury bills are like risk-free safety deposit boxes as far as these cash managers are concerned. So they go to repo, or they might go for a government money fund. So I think, you know, this product might potentially look very, very attractive for corporate treasuries. And so I think it's possible that we'd see large swaths of the shadow banking sector potentially disintermediated. But whether that's a concern or not, I think is an open question, given that the sector largely emerged out of the regulatory arbitrage that became available in the 1970s. So I think we could have a very nice discussion about that property of CBDC on banking. And of course, it feeds into the implications for monetary policy. I've recently been toying with the idea. I just attended a Bank of Korea conference where I expressed this notion, and they were very concerned about the emergence of these global stable coins, which look like basically global money market, unregulated, or money funds. And, you know, the concern is that, you know, imagine a tether-like object or something much larger that holds a large amount of commercial paper. And imagine a tether, not a tether that services the crypto trades, but services, I don't know, imagine it has clients like multinational firms and their affiliates, and they want to facilitate payments along the global supply chain, and they don't have to deal with the banking sector, right? What happens if this unregulated object becomes very, very large and poses a systemic risk? We might want to consider a CBDC, like at the US level or in Europe, to kind of encourage these corporate clients to use this product to kind of discourage the emergence of these global stable coins, or at least ensure that they don't get too big, given that they cannot be directly regulated. So I think that's an interesting possibility for monetary policy. In terms of like everyday monetary policy, I'm kind of, yeah, please, yeah.
Could it not just be the other way around? That when you have a CBDC, actually you will have more of the stable coins. So it's really a question of which infrastructure, as you know, my favorite topic there. Yeah. So the CBDC lives on an infrastructure that I cannot easily use. I create a stable coin as a mapping, and then that thing lives on the blockchain because it's so convenient for me to use.
Right. So then the question is but what is that stable coin going to be used as backing for its assets?
Yeah,
so
use the CBDC
yeah.
as backing, so which would be actually would be better than what we have now.
But then I would say, fine. I said systemic, global stable coins that would potentially pose a systemic risk. If a global stable coin, if Tether had reserves at the 100% reserves at the central bank, I'd say that's not a systemic risk. Yeah. So fine, I would encourage that.
No, so it's not so much about it being outside of the banking system in terms of how the transactions flow through the system. It's really about the systemic risk of the origin.
Right. I mean, Tether allegedly holds large quantities of commercial paper. Allegedly. You know, I mean, imagine a run on the commercial paper market that's going to have spillover for, you know, I don't have to tell you the story. So it's a thought. I mean, this is just, I don't know. Good point. Let's see. So this is not going back. Is it going back? I went one too far. I wonder if I can remember what was on my last slide. Oh yeah, you know, normal monetary policy. I just don't see what the big deal is. CBDC, just interest. To me, central bank digital currency is just a component of the interest-bearing public debt. When the central bank goes out and monetizes a part of the debt, all it's doing is converting some treasuries, interest-bearing treasuries that already exist on an account, like Treasury Direct, and it converts them into central bank liabilities, interest-bearing liabilities. It's essentially engaged in maturity transformation of the outstanding Treasury debt. I just don't get the big deal there. You know, details, we could set the CBDC, we could get rid of the overnight reverse repo facility, and just have the central bank digital currency form the floor of a channel system or the floor of a floor system. We'd have all the usual liquidity backstops in place for banks. I just don't understand what the potential financial stability concerns are. However, I haven't really read Harold's paper in detail, so I might want to Okay, let me conclude. Is a CBDC necessary or desirable? I mean, for the United States, I think the answer to this question is it depends. It depends on the use case. In some countries, I could see it. In the and I'm pretty agnostic, actually. I actually don't mind the idea. Is it necessary for a country like the US? I don't think so. Even for Europe, I don't. Europe is like, what's the problem at the retail level in Europe? I don't know if there is a problem. But like I say, it may be desirable, nevertheless, at the wholesale level to possibly discourage or disintermediate certain shadow banks and global stable coins that might pose a systemic risk. Thank you.
Thank you, David. So now Linda is going to give us a few remarks.
Yeah. So. I don't have any slides. I will stand here nevertheless. So, hold on. Okay. Okay. So, Harold and I, we have been working on CBDC and monetary policy for quite a while now, I think, with different co-authors. And you just saw one of our projects all over, I think. So in my opinion, the case is not really clear-cut whether CBDC has things to offer that we cannot accomplish right now. But I think there's one dimension that is interesting to CBDC that looks at a scenario where you take as given the rise of a large CBDC by a foreign country. Yeah, and so Paolo, Harold, and I, we have a paper, so we started working on that 2019, about what happens if you introduce a global currency to a two-country setting, where these two countries start off with having their national currencies and their national bonds. And then you introduce a global currency on top of that. Yeah? And you can think of this global currency as a CBDC. Yeah? A US-based CBDC maybe. Yeah? So a US CBDC, for whatever reason it is introduced, I think will be a hit. Yeah, it's the most stable US stablecoin that could ever be out there. And I think has certainly the potential to become widely adopted also beyond the United States if this is admissible. And if you start off with that scenario, taking as given the introduction of a CBDC that is used for transaction purposes in different countries, then you get quite interesting monetary policy implications, but potentially in a very disruptive way. So what we are looking at is or results that are well known in the literature is if you start off with a one country setting, national currency is used, then traditionally national currencies do not compete across countries. It's not the case that you can use the euro in the United States and vice versa. Yeah, it's simply not accepted and there's nothing that you can do about it. And what about bonds? Well, I, as an investor in Europe, I can invest in US bonds, but how do I do that? I'm exposed to exchange rate risk because I need to exchange my euros to US dollars, invest in US dollars, stay invested, and then exchange back. Yeah? And so an expectation, there's a relationship that has to hold across time, taking into account exchange rates. Yeah? So there's no direct competition between bonds that would be free of exchange rate, and there's no direct competition between national currencies. It's just not feasible. But if you introduce a global currency on top of that, and again, this could be a global CBDC, then, things change. So if you are an economist or you have a background in finance, you might have heard about the impossible trinity. Yeah, so in international finance, this just means if you have free cash flows, if you're free to invest, and you have a fluctuating exchange rate that's subject to market conditions, it is the case that central banks are free in choosing their monetary policy. Yeah, and so it turns out that if you introduce a global currency, this is not necessarily longer the case. It's rather that if central banks do not watch each other with regard to how they set monetary policy, they risk crowding out their national currencies. Okay, and so this is an implication of monetary policy caused by a foreign CBDC that is certainly disruptive. Yeah, and I want to give you a little bit of an insight where this result comes from. So you can think of it as famous result by Garratt and Wallace is simply if you have one country and you have two competing currencies, then across time the exchange rate has to be constant. Yeah, simply by no arbitrage conditions. And if you introduce stochasticity, then there's a paper by Andolfatto that essentially says that same results holds an expectation exchange rates have to be constant. Yeah, because no arbitrage competes these things away. Now, but again, we are in a two-country setting, so why should there be direct competition between national currencies? This is not the case per se, but what happens is if you have a global currency that you introduce in the same global currency that is used in both countries, then you're creating in each country direct currency competition, and through the global currency as a transmitter, in fact, you're creating competition between these national currencies. Yeah, so global currencies act as a transmitter and cause direct national currency competition. Yeah, and so this has implications for central banks to set their interest rates on bonds, because liquidity services on currency, they have to stand in a particular relationship to nominal interest rates. Okay, and so via no arbitrage, central banks are no longer free in setting their nominal interest rates. Okay, so another issue that I wanted to touch on is the introduction of a CBDC with regard to government spending. So we know that in times of crisis, we observe flight to safety by very large market participants, money market mutual funds, pension funds, and so on. So they're drawing their cash out of the market. Very often, in fact, simultaneously out of stock markets and, in fact, cryptocurrency markets right now. This is why we see the strong co-movement between stocks and crypto. Typically, then, there's a shift into government bonds. Yeah, because they are safe government bonds. Yeah. And now, but what happens if you introduce a CBDC and you allow international investors? If the CBDC is perceived as safer as certain government bonds, you're creating a shortage of funding for governments. And so how is this related to monetary policy? Well, we have just observed the ECB had an emergency meeting about nominal interest rates on Italian bonds, and apparently now synchronization of bond yields is an issue of central banks, and or has become an issue of central banks, and so this is something to take into account, yeah, when introducing a CBDC. Okay, thank you.
Thank you, Linda, and now Adrian.
So I prepared a presentation and then forgot to send it to the correct address. So I'm going to hold up the first page because it has two important bits of information on it. The first is that I'm not Mathieu Broussière. So I apologize for all those who came for the wit and wisdom of Mathieu. I am his deputy, and I will try to be just as funny and just as informative as he would have been if he could have been here. The second thing is it contains the standard central bank disclaimer that everything I say is my own opinion. Now that actually is also a warning that within the Euro system, the way in which we're approaching the introduction of a CBDC is quite Euro system, which means there's lots of national central banks involved, as well as the ECB, and it's also being done by multiple different services within all those national central banks. And I know a little bit about what's going on, but not everything. So you really wouldn't want to take away from what I say now, that I'm giving you definitive insights into the Banque de France's views on CBDCs. So my presentation, in fact, I started it 2 days ago when I found out I was going to be doing this, in part to clarify my own thinking. And it's a bit of a shame you don't get to see this. So it was around three themes. The first one is CBDC, it means different things to different people. Until recently, when I met somebody at a party and I said I was from the Banque de France, I mean, these days they ask me about inflation and you know, why I'm not doing something about interest rates. But before that, whenever I said I'm from the Banque de France, they would say, CBDC. And the first thing I would have to start asking them is, well, which bit of CBDC or what type of CBDC are you actually talking about? And so when I started thinking about that theme, it led me to think, well, why don't I just start with what are the different forms of money that are out there right now? So we have cash, I mean banknotes. We have private bank deposits. We have central bank reserves. And these days, there are different types of things that in my presentation I put in French quotation marks of stable coins and cryptos that have a kind of money-like quality but don't fit any official definition of money to date. And then you start asking a question, well, if you introduce a CBDC, it's in competition with which of those different things? And there are many different options that we can put on the table that are being explored right now that are in competition with each one of those. So you could imagine, for example, a kind of Banque de France debit card in which you could just go around and pay with a central bank digital currency, a bit like you pay now, contactless credit card. And so we're just, in that sense, disintermediating credit card companies or banknotes. So that would be a bare form of central bank digital currency. So that's one option that's on the table. The second is the one that in the last two presentations I heard being talked about, is that where it's a kind of substitute for private bank deposits. So it's a kind of store of value of some sort that may or may not be remunerated, but I don't think anyone's thinking that the central bank is going to start introducing a full service private checking account system. Okay, so even there, what we would actually be introducing and how it's in competition with these things is unclear. And then the one that gets everybody excited when I go to parties, maybe it's the sort of parties I go to, but they're really interested in this kind of tokenized assets and how you plug it into decentralized finance, and you can do all kinds of funky things in payment systems for financial assets. And all those things have completely different kinds of features. And what I wanted to say on this slide was, first of all, there might not be just one CBDC. Central banks might introduce more than one. Different central banks might come up with different options. And if they have different ones, you have to think, how are they all fungible one to the other? Because I guess one of the things that we as central bankers hold most dear is that a euro is a euro. No matter where it is, it's a euro. And so you ought to be able to, at some point, be able to it's not convertibility, it's fungibility between different types of our liabilities. Now, it's not absolute. So first of all, non-banks don't get to go to have reserve accounts. So that's already one friction that's between convertibility. Another one that was really useful for us in recent years is that the friction between holding a banknote and bank reserves is not that easy either. So everyone in theory thought that the ZLB was the ZLB. Well, in fact, it's not that easy if you are a big bank to say, I've got 100 billion of reserves, can I please have some banknotes? They pretty soon realized it was not a good idea to try and do that. And so we could lower interest rates on reserves to minus 50 basis points without a rush of everybody to go on, of banks to go and turn this into banknotes. So there are these kind of things where there are some frictions in the fungibility that when you think about introducing a CBDC, how might that change those options of fungibility and how would they all fit together? And so these are a bunch of really important design questions. And so, as I said, when you go to a party and I say what CBDC, it really depends on which one you're talking about. The second thing I wanted to talk about is what features of money are actually important.
Excuse me, may I interrupt, please? So I heard you mentioned that there might be more than one CBDC per central bank. Did I get this correct?
That's a possibility.
So,
As I said
I mean,
from the disclaimer, I have no, I'm not giving you any
value for
privileged
this?
insight.
I mean, any value out of this suggestion or concept or idea?
Sorry?
What would be the value of such a, I mean, like,
Because they serve different purposes. I mean, you could, something where it's purely a substitute for banknotes, so you can easily go and have really small value payments that are instantaneous in the way that a banknote is. I mean, you just have a card that would look, you could even make it look like a banknote. You know, you walk around with a card and it's a bearer instrument that you can just exchange immediately with somebody else who has a compatible technology. And that could have, that you could introduce that independently of whether you were doing these crypto tokenized assets. That could be done separately. Now, I don't have any privileged insight as to whether they're going to do more than one thing or not. I just wanted to tell you that there's this, at least a possibility that because there are different technologies and they're competing with different types of current instruments, you know, you may end up with different choices in different central banks and potentially more than one. So it doesn't, in other words, don't just talk about CBDC as if it's one obvious term. That's, in a nutshell, what I really wanted to say. The second thing I wanted to start, a theme I wanted to talk about was, in some ways it goes back to a really old debate, like what is money and what's it for and why does anybody want to hold it in the first place? And when I was in graduate school, there were all these different competing theories about why people want to hold money and what features of money are important. And so I listed a whole bunch of different things that came up. One question is about anonymity. So there's an argument about, the great thing about banknotes is that there's no history to what you did. There's nobody who can see what you did. Now, that doesn't necessarily mean that there are plenty of things that are legal that people would rather that other people didn't know what they were doing. Now, revealed preference is that lots of people pay for things that perhaps they don't want their mother to know about with a credit card, so they seem to be happy that their bank knows about this, but maybe they don't want their central bank to know, because we're an arm of the government, in a certain sense. So, how much do people value the possibility that they can make transactions without anybody really knowing or tracing back where it comes from? On the flip side is, we don't necessarily, as central banks, also want to be labeling something that terrorists can finance using a form of central bank money. So these questions of anonymity and how much people value it and how much you have to plug it into the design of things is important. Ease of payment. Already in Europe, you can pay for something with ultimate settlement in a bit under 10 seconds if you want to pay for it. So instant settlement exists already. So it's quite expensive, but there's no reason why it should be. But how much do people really value it? It's obvious that when they have this option, nobody takes it up. So retail, they don't really care. So why introduce something that can make instant payments if you don't really care? How important is wide acceptance of an instrument? Can we have niche central bank currencies that just circulate amongst a few people because that's what they do and they like it, and in fact the general population doesn't use it at all? Does that change anything about the nature of money? Protection from theft. How much do people value the possible, or how much are they willing to give up in return for having some kind of protection? So banknotes are the ultimate thing that somebody can steal. This morning I had to try and make an electronic transaction. It took me about 5 minutes on the internet to fill out all the different security checks, and then, you know, the security code that came on my phone. It's not easy to make transactions online, but do I care? I mean, I'm happy to do that for certain transactions, but here again, how much ease of payment, risk of theft are things that the consumers really care about, and therefore what features we have to put into any kind of CBDC that we design are important things to bear in mind. And of course there are trade-offs between these different features that will that we also have to bear in mind. So the final one, and I guess this maybe echoes a little bit the slide that Harold put up. What are our responsibilities? I mean, as central banks, what do we care about? Now, there are obviously the statutory ones about price stability. In the US, there's dual mandate. We all have financial stability ones. Then there are a few that are, actually some of them are not really written down, but they're still there. One is guaranteeing a public means of payment, that everybody can pay with the same money is in fact something that every citizen should be able to have. Guaranteeing that is something that central banks, I think, hold dear, that there are not parts of the population that are going to find they don't have a means of payment. Moving a bit on that theme, there is something about the digital divide. I'm a Parisian. I'm not by origin a Parisian, as you can all tell, but I'm Parisian. And so within Paris, I don't think I've touched a banknote in 5 years to make any form of payment. Everything is electronic. But as a good Parisian, I also have a weekend house. And there, when you go to the country, nobody pays by anything. It's all cash and checks. You go to the supermarket and people pay with checks. This is a real different world between what goes on here and what goes on elsewhere. And I'm pretty sure that any country you go to, this divide is true. And it's the same with phones. Harold was talking about his phone. Some people have really clever smartphones. One of my acquaintances in the country, he's just got his first mobile phone. Okay, this is something that if we introduce things where only a certain proportion of the population have the capacity to use it, this is not, I mean, whilst it might be a great improvement for those people, it's not necessarily a social improvement if it crowds out effectively access to payments to a bunch of people. So I just wanted to put that on the table. And then as a final point, and then I'll stop, is the international role of the euro. Now that's something that in the original kind of origins of the doctrine of the ECB, they didn't care. And at some point over the last couple of years, it has become the doctrine that they really do care that the euro is an international currency. Now, I would, with all prudence, say that at least one of the reasons why the ECB and the euro system is now thinking about a central bank digital currency is in fact also to protect the use of the euro within the euro area. That in fact, I mean, already all the credit card systems that we have in Europe are foreign owned. Our mobile phone systems are now mostly made either in America or in China. People are a bit afraid of the idea that our own payment systems could be completely controlled by non-European entities. And I say this honestly. And if we find that technology races in such a way, and there are no European players in this market, this will be something that European institutions will be very unhappy with. So at least to some extent, things like the introduction of a Euro CBDC is also a way of making sure that we maintain and can encourage a Euro area payment system providers and therefore have some degree of control over the payment system and the information that's contained within payment systems within Europe. I can develop any more of those themes during the discussion.
Great. Thank you very much, Adrian. So my plan now is I'd like to maybe ask each of the panelists a follow-up question, which they can answer, and any of the panelists can also chime in on as well. And then we'll go to some general questions from the audience. So I think I'll start in reverse order. So I'll start with you, Adrian. So first of all, you mentioned the idea that there could be a central bank could issue multiple versions of a CBDC, and there was a question about that. I think we've already seen this. So if you if you look at some of the instances where CBDCs have been launched, even the crypto versions in the Bahamas and so on, they issue essentially different versions of a CBDC where you have different rights and privileges depending on what the transaction limit is or what types of parties you're going to transact with. That is, if they're P2P or P2B or so on. So we've already seen this idea out there. But my question actually relates to the idea that you also brought up about this, essentially this notion of singleness, which is a term that was brought up in a BIS report on the role of central banks in payment systems, which is this idea that there's quite a triumph in, I think, in central banking world that often goes unnoticed, which is this idea that commercial bank deposits trade, in most countries, trade one for one. A Bank of America, sorry to bring it back to the US, but a Bank of America deposit trades for a Citibank deposit, trades for a Union Bank deposit. And this is a real triumph that generates a lot of efficiencies. And so I might ask you the following, which is that in a world where cash disappears, is that singleness still possible without a CBDC? So what I'm alluding to is the idea that cash might somehow play a role in maintaining this singleness. This idea that when we have commercial bank deposits, we all visualize that what those commercial bank deposits represent is a physical dollar. If that physical dollar is gone, do we somehow lose that anchor? And is it possible that a CBDC might be necessary to get that back?
That's a difficult question. I can see two answers to it. One, at a purely psychological level, you're right, in the sense that a euro bill, that's what people think about, and they have this impression that their bank is stocked full of these euro bills, and their euro bill that they took in 2 weeks ago is still sitting there, and they can go and get it again. And they don't really understand that, in fact, no, that's not there. It's disappeared, and the banking system has lent it out. And, you know, so this substantiation of your currency in some form, I can see a psychological argument that could go that way. But really, I think the reason why euro is a euro or a dollar is a dollar is more to do with the fact, in my opinion, that banks have access to a discount window, and therefore they can all go and get a reserve, if necessary, against assets. I mean, you realize that it doesn't work dollar for dollar when banks start to fail. That's when actually maybe my deposit is not quite. You get bank runs precisely at the point when people start to think, actually, maybe that dollar or euro I have in that bank is not going to be convertible one for one at some future point, because my bank is going to lose access to the discount window because nobody at the central bank is going to trust it anymore. So I'm not convinced that we would have to have one in order to do that, except for modulo this kind of psychological argument that people in a way need to feel that they can touch their money in some tangible form. I mean, it's a bit weird to talk about a tangible form of a digital currency, but I guess you know where I'm heading.
Yeah. And so maybe I'll thank you for that answer. I'll generalize the question somewhat slightly and then ask if any other panelists want to respond. Is there any problem at all if in maintaining the way that consumers think about or deal with payments if cash completely disappears and all payments are electronic?
No. Because I think the Bank of Sweden is particularly interested in this question too. But I can imagine, well, actually writing it down in a model, the demand for cash, physical cash, evaporates. But what's still true is that as long as the central bank money, the reserves in this case, are exchanged at par for deposits in the interbank clearing, I mean that serves as the anchor. You don't actually need a physical manifestation to be circulating hand to hand in the general public to maintain that.
Can I add to that? So, sorry. Yeah, I think From the consumer perspective, I would answer this question differently depending on the design of a CBDC. So if it's not preserving privacy as much as cash would do, I think there's certainly a difference because I can no longer control whether I get my transaction to be observed or not. Because right now I can go to a restaurant, I can pay in cash, I can pay with my credit card, my debit card. That's my choice. If that choice is taken away from me from the perspective of a person, that's a different kind of scenario. It's like going to a restaurant and you have the choice to eat whatever you like, and then all of a sudden your restaurant only offers one choice. It feels different. And even if you always opt for the credit card or some form of electronic payment that leaves traces, it's different whether you make that decision or whether it's a governmental sort of institution, I think.
Can I just clarify that the Eurosystem has no intention of abolishing cash? I mean, it can die out when nobody wants it anymore. And I guess I did express a concern that there are multiple equilibria in this because if you talk about the acceptance of something and that sooner or later the demand for cash starts to diminish and people start to refuse cash in certain restaurants or bars, and it starts to disappear, but the people who really are attached to this find that they're therefore excluded in some way would be problematic. But there's no intention to get rid of cash, and so we won't find the situation in which people want it and they can't get it.
Yeah, no, I wasn't actually suggesting that, although I'm not so sure that the last part is true because there is this sort of tipping point. It is costly to deal with cash. And so at some point, businesses find that it's not worth it. And so even though some consumers might want to use it, it's no longer available. But let me move on. Let me now ask Linda. So you mentioned aspects of flight to safety into CBDC. And so one of the things that occurs to me is that one of the things with typical flights to safety, if we think about flights into treasuries, there's this silver lining in that as people fly into treasuries, it changes the rates and makes treasuries less attractive, which can somehow mitigate the flight. With CBDC, there's no such natural mechanism. And so would you envision that it would be reasonable to impose some types of mechanisms to sort of limit a flight to safety into CBDC?
I think in the end it might be, I'm wondering whether it's the same thing. I mean, as a central bank, apparently by quantitative easing, central banks try to signal and try to take or make an influence on bond yields. Yeah, and at the same time, they could set the interest rate on CBDC, so it wouldn't matter much. Certainly, a flight towards CBDC could be deterred by, I think we saw this today, by putting negative interest rates or some kind of way, or yeah. I think it wouldn't matter.
Okay. Anyone else have a response? Yeah. Yeah. Okay. Yeah, I think I was getting more at the notion of that one is a sort of a market response and one is a direct policy response. But I agree with your answer that the Fed also can influence the Treasury rate. So in some sense, both might be considered a policy response. Could
I add something on
sure,
to that? So
sure.
A CBDC might be, and so Julian, when we were talking about this, a CBDC would be unified interest rate available to all citizens in the euro area, whereas the interest rates on bonds would, of course, be country specific. I should also say that.
Just to follow up on that, yeah, so I see what you mean by the distinction. One is kind of market-based. The other one requires the policymakers to. The same sort of concerns were expressed when the overnight reverse repo facility was established. I remember John Cochrane writing extensively, warning about the possibility of runs. Of course, none of that materialized. Okay.
Okay. So then lastly, and I'll open up to the general audience. So David, you basically said that you saw no obvious role, monetary policy benefit to CBDC. But we live in a changing world. And so I'm wondering if you think conditions in the future will make it, this is, putting on or looking into your crystal ball. Do you think conditions in the future could change in such a way that a CBDC would be more valuable or less valuable?
Okay. First of all, I'm speaking on my own behalf and not. I always forget that qualifier, but yeah, the future. It's hard to well, so many possible futures, But at the end of the day, we're talking about bookkeeping. This is these are balance sheets and debits and credits and interest rates, and there may be some advantages, to operating monetary policy through a CBDC. So, some people advocate negative interest rate policy. I actually, as Europe has demonstrated, we don't actually need CBDC for that, although it may be more convenient to do it through these mechanisms. But the basic principles of monetary policy and fiscal policy, I don't know. Maybe I just lack imagination. I can see the technical operations changing and molding themselves to the evolving technology, but in terms of the basic economic principles, I don't know.
Yeah, I pretty much share the same view, but I will pick up on this point about the ZLB, ELB, because it does make quite a difference. And one risk here would be that, as I alluded in my presentation, we could go negative because the fungibility between reserves and physical banknotes is not easy. But if you introduce a CBDC, is it remunerated or not? And if you remunerate it and say it's going to be like cash, then it could be remunerated, it would be remunerated zero. And now suddenly you have an instrument that people can run to that's central bank money. It's potentially, if it's held somewhere that's secure, safe from theft, that would actually reinforce the ZLB at zero, with some implications. So I can see some dangers for monetary policy from different choices that we might make, but the fundamentals, when we don't put CBDCs in a standard New Keynesian model, we still would have the same features of Euler equations and why people will want to bring forward consumption or to do whatever they do. Those mechanisms are still going to be there, whether what's going on in the plumbing of how people pay for stuff, it could have some effects, but I don't see it having first order effects on the way we would run monetary policy.
All right.
Can I add something?
Sure.
I think what's missing for me is something like, what's the design purpose of CBDC? What is it really supposed to do? Because we were talking about, if we introduce CBDC here and there, it's going to cost that, and if we introduce it in that direction, then it's going to have these implications. But what's missing from my perspective is the statement we're introducing a CBDC for that particular purpose. And one point that emphasizes this is the debate about putting an upper limit on CBDC holdings of citizens or entities. I don't understand why we are talking about introducing a CBDC if at the same time that product or asset is not supposed to be popular. So I don't understand that aspect, I have to say.
All right, thank you. So I think I should open it up to some general questions. I guess whoever they hand the mic to first, and then we'll get to Harold and then at the back.
Okay, so then, since I have the mic, so maybe I should remind everybody of why there was such a high-powered discussion around CBDC starting around 4 years ago or so, which was the arrival of the Libra/DM network from Facebook. That really started the discussion to get very serious about it, and there was a reason for it, because all of a sudden we're talking about a private network issued by a colloquium of private firms issuing digital money, which has so many different implications for people's privacy. People may give up their privacy in their payments without actually realizing, as people do it already when we talk about Facebook and the use of social media. We know that there is harmful effects of that for children and youth. So what comes when you have the same thing with money? There could be geopolitical problems if, for instance, say a DM coin becomes the major form of payment in one country, and then for whatever reason somebody sanctions Facebook and says you cannot use it in their country anymore. You can have riots on the street. There's so many implications for that. You've not touched upon any of that, so there's a bit of a discussion of,
what could possibly happen? Right? So, there is always the possibility that, say, Amazon comes up with its own coin. In its entire global supply chain, everything is paid by an Amazon coin equivalent to the US dollar, which could be extremely disruptive on so many levels. So maybe can you comment on that threat and that possibility of whether or not that changes your mind of the introduction and the need for a CBDC?
Can I answer to that? So I think these are two different issues. First is the issue that a central bank might be threatened by the introduction of a foreign new kind of money. And the second issue is the belief that you could eradicate this threat by providing a product that's better. And in my opinion, you don't have to provide a CBDC to deter Libra or Diem. I think it's not necessary because central banks also regulate and governments regulate. So they provide regulatory frameworks for data security, for customer protection, and so on. And I think this is actually what we've seen happening. So the reason why Libra and Diem is not as successful as we initially expected them to be was not that the ECB or the Fed started discussing about a CBDC, but it's the regulation behind that, I think.
Just very quickly, I think I brought up a point that's similar and supports that concern, Andreas. So it may not be necessary, but yeah, for sure, we know that that's what stimulated the discussion. And for sure, I think it was a good discussion to have. And I think in principle, we could imagine how a well-designed CBDC could serve as a competitor to kind of discourage the emergence of these objects that might be more difficult to govern, although, as Linda pointed out, they can be regulated, but for all the concerns you raised.
No, I completely agree with your point. I think I alluded to it, that it's actually part of the sovereignty of Europe, that it can control its own data. And you're right, it was the threat that potentially there's something else that, for reasons we couldn't quite understand why people would want to do this. And so it's kind of collapsed sometimes of its own accord, these different things, but they still had the possibility of creating equilibria that would be uncomfortable with. And it's true that we could regulate away the problem and insist that, you can't pay in certain forms of private monies, but could we stop it if it took off in a massive way is a question. And so it was in some sense a defensive mechanism or a defensive response to those risks.
Hi, I'm Jack from R3. I spoke earlier today highlighting privacy, and I'm just pleased that some of that's coming back from me from the panel that we have in front of us. It may well not be the job of a central bank, but when Libra sort of picked up and said this is what we want to do, they highlighted remittances as a failure within the current payment network that could be addressed through their use case. I wonder whether there are thoughts from the panel on how a CBDC designed for remittances, and it's relatively, I think, it lacks some of the complexity within a shared currency, but perhaps cross-border where there is cross-currency too, whether there's an assessment of the monetary impact from the introduction of a CBDC for a narrow purpose, such as remittance. Does it contain some of the same threats? Is it the same set of questions, or are they different questions we should be looking to answer?
So I would question whether Libra really was designed for remittances, but I'll allow the panelists to respond.
Yeah, certainly that's a use case. Actually, that was a use case for Bitcoin as well, I think. But that market, people have mentioned how broken that market is. They've mentioned Western Union, and I think the poorest people in the world pay something like $50 billion in facilitating remittances, but is a CBDC, the question I think is whether a CBDC is really the best vehicle to address that concern. I mean, we're talking about debiting and crediting accounts in a ledger. Let PayPal do it, for example. What's preventing, or a PayPal-like object, whatever it is. What is it that's preventing the private sector from providing this service? In sub-Saharan Africa, M-Pesa jumped at the opportunity. What is preventing this from happening in other jurisdictions? I suspect in many cases it's regulatory. The regulatory structure might be preventing it from happening. And maybe not, but if it is regulatory, then the answer is really attack the regulations directly rather than introducing another object that can bypass those regulations, would be my view on it.
Can I add something to that? So I think one aspect to that is that Libra was designed to be its own currency, whereas national currencies are constrained to their according jurisdictions. And so Libra might have eased remittances, but it would also have bypassed exchange rates. And I think when we just talked about a CBDC that could have been designed to counter Libra, CBDCs currently are not designed to be global currencies. They're designed to be CBDCs within their currency area. They're not designed to become global CBDCs. So I think that's yes.
Across the union, that's sort of one of the use cases I'm thinking about, because obviously domestic payments with the Eurozone within jurisdictions are pretty good. Across Europe, though, not so much.
Okay, but it's still a difference whether you are paying. Okay, so as soon as you are usually, as soon as you're leaving your currency area, you will pay the exchange rate that's subject to market conditions. If you are making that payment in terms of Libra, you don't have to exchange. You're bypassing exchange rates. You're essentially, the Libra platform or whatever platform it would have run on would have created an own currency area. It would have bypassed currency areas. And I think that is something that governments were not happy about.
2 points. First of all, I have to go in 10 minutes, so if you have an urgent question for me, can you ask it next? The second is, I go to great parties, as I said earlier, and when I interrogate people about why they want to do these tokenized asset exchanges, and you really push people, you find out that actually it's to do with reducing the costs of back office functions, that apparently settling bonds exchange, you'd think this could be really done quite easily, but apparently it takes a day or so to clear who owns what. Do they have it? Do they have their, is it tied up in collateral somewhere? And so actually one of the things that all these tokenized finance initiatives are actually about is removing this back office function. And so you think, well, hang on, that's absurd. We're going to introduce something as complicated as a central bank digital currency when surely in the wit of it's just on a ledger somewhere. We can't find some other clever digital way of doing this faster. So I take your point that the CBDCs can be helpful in getting around various things, but they don't often sound like a solution when they're not going to be the best solution to this question of how to improve remittances. I mean, I perfectly agree. It's an extortion, the costs people pay to make transfers to poor countries. Surely we can find better ways of doing this than introducing central bank digital currencies.
So can we get Harold, that has been patiently waiting?
Yeah, so many issues. So I'd like to know from all panelists if they can each pick their number one reason for introducing a CBDC, and then given that reason, whether they think CBDC should be introduced or not. I sort of feel that maybe the Libra discussion, got the central banks into action, and then Libra was, fought down through regulation, as Linda pointed out, and now all these CBDC papers get written and so forth. But maybe this is just dragging his heels and getting lost in the sands, and nothing's going to happen. So, I mean, is it going to happen or not, and why?
Linda handed me the microphone. She thinks I have an opinion on this. Can you believe that? Okay, best use case. I think Best use case for me would be kind of for the reasons I cited, a potential for disintermediating shadow banking sector and discouraging large global stable coin from emerging. And essentially, the concerns that Andrea's expressed, we had this Facebook or in the future some private consortium arising. I think as a basic check and balance, as a basic public option, it might be something to consider. Just like, I don't know, the post office, the US Post Office. I mean, it doesn't always work that great, but that's the best I can do, Harold.
I think I agree with David in the sense that if you add just an alternative, you not necessarily make things worse, but not always. But if you replace CBDC for cash, I think that wouldn't be a good idea. And also if you start paying interest on CBDC in order to increase adoption, I'm unsure whether that's a clever idea. I think disintermediation in the banking sector is unnecessarily squeezing banks. Banks are already highly regulated, and I think it's important to take into account how regulation would interferes with the extent to which banks can make money. So I think that would need to be weighted against one another. So if a CBDC is introduced next to cash, I'm fine with that. Otherwise, I think that's not a good idea.
I'd love to introduce a Banque de France debit card and use it with helicopter money. So I would be able to credit everybody's account instantaneously with 50 euros with a very negative interest rate that it will disappear within 2 months if they don't spend it, as a means of different kind of monetary policy instrument. And that's never going to happen. So I can see one case, but until I become president of the ECB, this is not going to happen.
Thank you. So I think we're almost out of time, but Julian, would you like to ask the final question?
So maybe it's just my impression, but I felt not such an enthusiastic case for CBDC. And as you said, things have changed a lot in 4 years. So, and in 4 years, it seems that actually central banks were pushed against their will to do it by a threat more than anything positive. Since the threat has disappeared, the will has disappeared too, which is not surprising. But I think you alluded to something when you were talking at parties and meeting people who do funny things with DeFi and so on. And I would not be that dismissive about it. Because I think this technology, although we have seen a crash, is doing things which are going beyond just streamlining back office. It's doing back office in a completely different way. It's not like the old way of doing back office. It's doing back office across the world in a completely different, with a completely different technology. And the thing that is puzzling me is that you have all this asset, all this new technology emerging, and there is one thing missing there, which is money. Everything is getting tokenized, everything is getting virtualized, but one thing is missing there is just proper money. And then what we get is stable coins, and we have seen what they do. They are a huge source of instability. And okay, maybe it's just going to be a sideshow for a long time, but I will not be that confident. And if it grows again, then that's why we will need a CBDC to have like some kind of backstop and stable representation of money in that world. And that's, for me, that will be a motivation. And clearly, people from the blockchain community, that's what they are waiting for. That's what they are expecting. But since they see that it's never going to happen, they are going to go their own way to find a way to generate some stable source of value without central bank. So now the bet is that they won't manage, but who knows?
Yeah, no, that's a good use case. But I mean, I guess the question in principle is why a central bank is necessary to provide those services when we already have digital money. It's called bank deposits. And so then the question boils down, what is the friction that's preventing these entities and banks from collaborating to make whatever they need to be done? I mean, why does it have to be a central, whatever the central bank can do in terms of design, I presume these private banks could do in principle. So then the question, and they're doing it? Okay, so they're doing it, and so then the question is, if they are doing it, and we can expect market forces to deliver these services to service the needs you just highlighted. I trust the private sector more. I trust whatever motivated M-Pesa to deliver stuff than I do state banks, for example. I think central banks play an incredibly important role at some level, wholesale, regulatory, all these things. But in terms of servicing, high volume, demanding, at the retail level, our experience with government kind of managed services is not the best, I don't think. Although in principle it could work. I'd be myself personally more comfortable with letting the private sector and removing the barriers, whatever barriers there are that are preventing those technologies from being adopted and those services from being provided, before I would consider, okay, as a last resort, this isn't going to work, let's just start from scratch and have the central bank do it, this is how we're going to do it. Kind of like how the Federal Reserve was founded in 1914 after the crisis. They said, okay, enough of this, enough of 30 years of crises managed by the private consortium of JP Morgan. We're going to institutionalize this and try to, not that Harold's going, well, how did that work out? But yeah, that's my view.
I agree with you that the private sector probably fosters innovation more than governmental institutions would do. But there's one difference between the market and government institutions, that's accountability. Yeah, so the Terra Luna scanner just showed, there's a huge amount of money that just vanished. And who's accountable for that in the end? It's the consumer, right? So there was no regulation in place. This was free market, and everybody should have known, could have known, potentially that, an algorithmic stablecoin is only so stable until the next panic. And if instead a governmental institution would have stood behind such a coin, that would have been accountability, and this is not the case here. So I think there's a difference. Yeah. And one more difference is that from private institutions, from private entities, it's the lack of transparency that will play a very large role, I think, in the future, because now apparently people have maybe woken up to false promises, I guess.
I think Claudine this morning gave you a very detailed presentation of the number of different kind of experiments that the Banque de France has been doing. I don't think that's going to stop. In fact, it's one of the most un-central banking things I've ever seen, is the idea that central banks go out and experiment with different options. It's not within our DNA to do that, but we have done it, and I don't see any reason why we'll stop doing it. But I think we could pose exactly the same question that we've been asking about. What is CBDC is a solution in search of a problem. I have the same impression with this tokenized finance, that no one has yet explained to me it's the solution to what problem that we need to do all this. And I guess it's always the wrong way around to go about the question. We should really identify what is exactly the problem, and then why the proposed solutions are the right way, rather than necessarily just push ahead with an idea because it's the one that happens to be there. But I'm sorry.
Yeah, no. Okay, thank you. I think we better conclude. So let me thank the panelists. Let me thank the audience for excellent questions. And we'll see you all tomorrow.